Thank you, Manny. Thank you so much, Manny. You're such a pleasure, and it's a true joy to be here tonight. Thank you so much for the opportunity, to Manny, to Dinah, and all the team. And as Manny said, this is going to be somewhat different, I understand, from what you're usually used to. I'm a fundamentals person, less technical, so you'll get a different flavor. And please do interject. You can just call out. You don't even have to raise your hand. Just call out if you want to call out. I think it's much more fun for you and for me if while I'm talking, you also get to say something, okay? So if you disagree or if you have a question, please jump in. I encourage you to do so. All right, so let's get into it. I'll start with the Fed because the Fed means the world of difference. So as you can understand, so I'm a cross-asset strategist. So we do Forex, equities, and fixed income for the firm, as Manny said. So my clientele is usually institutional investors. So it's a true pleasure for me to be here with you too, because it's different for me. It's different for you, different for me. So the Fed really sets the tone because the discount rate is what everything is valued off of. The risk-free rate is how we derive, valuations and cash flow. So all of that makes a difference. For you all who care more about Forex, we're talking about the carry. So let's talk about the Fed. The Fed is in an interesting position right now because real rates, which is the Fed funds minus inflation, is historically very, very high. So the Fed is at 375 right now. When you subtract out inflation, that's about 1%. That's historically high. We've had real rates being negative. But despite real rates being so high, which is restrictive, meaning it pulls money out of the system, less liquidity in the system, it should slow down the economy. It should slow down lending. It should slow down equity performance. It's done everything but. Okay? So what we have at this moment is, despite really high real rates, financial conditions are easy. How do you measure financial conditions? This is a compilation of various metrics. It's done by the Chicago Fed. So this is the National Financial Conditions Index. We are at very loose levels. We're at the loosest level since the early 2020s. How do you measure that? So there's different ways. One is equity markets at our all-time record highs. Credit spreads are at all-time tights. It's easy to get credit. It's easy to get a loan. Those are easy financial conditions. Counterbalance that with risk assets being very high. Liquidity remains ample. So how does the Fed cut into that? The Fed is already cutting. So where am I getting to here? The Fed is fine with this. The Fed is fine with inflation being at 2.5% to 3%. Remember, core PCE, the target is 2. We're at 2.8. And we're going to stay there. So we're probably going to be between 2.5% and 3% for the foreseeable future. The Fed during COVID here in 2020 ramped up quantitative easing, the purchase of bonds. So what they were doing was to also facilitate liquidity and make financial conditions easier. They were buying bonds and they were buying some other things, mortgage-backed securities and other things. And so what they did is, instead of buying new stuff, they just reinvested rollovers. So what they did recently is say, I'm not going to reinvest anymore. So the Fed's balance sheet, which is how much they have in assets, is still at a historically high level, but it's off of the highs. The fascinating thing here, everyone, is that the US economy is growing at 2.5%. We have a fiscal deficit of 6%. The Fed is cutting, and the Fed's balance sheet is at all time is pretty close to the highs. It's lower, but it's still off the highs. Point being, inflation is still here. It's going to be here for some time. Okay, so the Fed's 2% target never going to change explicitly, because it's a death knell to credibility. They've already suffered quite a bit on the credibility front, but it's a death knell to credibility if you change your target before you get to said target. Right? So they're not explicitly changing it, but implicitly they already have. Because the Fed has missed their target for the past 4 years. And in their summary of economic projections, they don't see it getting to 2% for the foreseeable future. So they're cool with 2.5% to 3%. Okay? My sources tell me above 3.5%, they start to get very concerned. So if you see a reacceleration of inflation, I'm talking about core PCE, which is what the Fed cares about. I'm not talking about headline. I'm not talking about your home prices. I'm talking about core PCE. which is the basket of consumption that the Fed cares about. If you see that break 3% for the upside, the Fed is going to get nervous. At 3.5%, by my estimations, the Fed considers hiking. Now, if the Fed hikes, that has ramifications for the dollar, for the S&P 500, which is trading at all-time record highs, and it has repercussions for fixed income assets. U.S. consumer, pretty resilient, pretty good. Now, the Conference Board, so I look at two things here. Consumer, the U.S. consumer is the backbone of the U.S. economy. It's what drives the economy. And then what drives employment is small businesses. Small businesses are what drive employment. So for me, this is the biggest leading indicator I can look at. You see Conference Board consumer confidence in a downtrend. Now, interesting about this particular data point is that consumer confidence, has anyone heard of Conference Board versus University of Michigan? Okay, so those are the two main consumer confidence surveys, and they determine how people feel. How are you feeling? Do you feel like it's a good economy? Are you taking your vacation? Are you spending more? Are you cutting back? Okay, this one is particularly tied to the unemployment rate. So what's interesting here is if were I to plot consumer confidence from the Conference Board versus the unemployment rate, they're inverse. So essentially when the unemployment rate's going up, Conference Board is coming down. So guys are feeling less confident. If you lose your job, you're less confident, right? But if your neighbor loses their job, you're less confident. If you take a pay cut, you're less confident. So this closely tracks the labor market, and the labor market has been slowing. It has been slowing. So I think Manny suggested this, and that's correct. All of these slides, including all of my notes, are available to you afterward. I'm happy to send it to you. But this is essentially my summary of the economy. AI-driven investment, a big deal. And I'm happy to talk about that. Please raise your hand if you have any questions, but I'm going to get to that a little bit later. Federal Reserve rate cuts, as I say here, hinge more on financial conditions than the inflation target. So if financial conditions keep getting looser, it's going to be really hard for the Fed to continue to cut. And by my estimation, the Fed doesn't cut before June of this year. So a lot of guys thought, oh, this didn't come out right. So you'll see it in the presentation itself, but somehow it's not appearing here. But there's a faded background right there, which shows what productivity is like. So productivity has been getting quite a boost, but it's not from AI. Productivity is a great thing for the US economy because it means that we can absorb more inflation. If the US economy is being more productive and we're getting more output per unit worked, then we can absorb inflation. So the secret sauce to this whole thing is productivity. If productivity continues rising and staying at about 2.5% to 4%, it's really, quite frankly, awesome because we're at late 90s productivity boom. This was the tech bubble, remember? And now we're in the AI. I'm not going to call it a bubble because it's not. We're not quite there, but we're getting there. We're getting there. And I'm gonna postulate something a little bit different from consensus. This productivity growth that we're seeing at 2% dwarfs into comparison to what's coming in the pipeline. Because AI, everyone's talking about it, everyone's investing in it, but they're not using it. Very few are actually deploying it. In the real economy, in Wall Street, very few are actually deploying it. You know how I'll know when they're actually deploying it? When we have mass layoffs. That's how I'll know we're actually deploying it. Creative destruction. So right now, this productivity numbers, these are, in my opinion, aftermath from COVID and the lagged effect of the internet boom. So what I'm proposing here is that productivity in the pipeline is going to be huge. But I'm going to put it at 10 years from now for the AI investment to start to pay off. And that means replacing jobs, that means productivity gains from automation and the like. Now, with all of this going on, corporate profits are at record highs. So the Fed can be at 3.75. Inflation is still around. You know, tariffs happened. April 15th, we saw the markets freak out, including I thought we were going to enter into recession or stagflation, which means higher inflation and slow growth, or God forbid, negative growth. Did not happen. What happened? Not only did the corporations absorb the interest increase in costs, profits have increased. So, yes, Manny.
Kathryn, I have a question. We're looking at corporate margins here. If these dwindle moving forward, let's just say, what impact do we think we would have on the Fed's ability to move on rates?
So that's a great question. Thank you so much for interjecting, and please everyone else do the same. So I think corporate profits are what we need to look at. And in Davos, one of the CEOs talked about this as well. You can just cut through all the noise about geopolitics and all that stuff and just look at profits and earnings. Because at the end of the day, the markets are based off of, is a company profitable or is it not profitable? So so we have the S&P right now, which is at all-time record highs and 3 standard deviations above the mean. So it's very overvalued. It's very overvalued. To directly answer your question, were earnings to disappoint and profits to disappoint, with a valuation as extended as what we have, it amplifies the reaction, okay? So valuations being as extended as they are, AMP is an amplifier. Valuations are not a forecaster, they're an amplifier. So if earnings beat big, like NVIDIA beat, the market's like, that's awesome, and it's gonna jump another 2% on the day. If they miss, and I'm talking about NVIDIA because it's 7% of the S&P. If NVIDIA were to miss, or let's say this little nascent downtrend continues, then you get a repricing of the valuation because you have price over earnings, and if earnings don't keep pace with the price, you have a correction in the markets. So I would say that, as I say here with this slide, margin compression worries me a bit. We haven't seen it yet. Maybe we're seeing the beginning of it here. But what that would mean for the Fed is if we get a downslide in the markets, which the Fed will say we have a dual mandate, the Fed cares about the markets because they care about financial conditions. So if the markets tank and you have a slowing labor market and you have slowing growth, I think the Fed cuts more than my baseline is counting for right now. My baseline is 2 cuts this year, June and November, 25 each. That's under the expectation of US growth staying strong this year. There's no indication otherwise at this point. And that's with an S&P, I think, growing 10%. I think the dollar continues to weaken from here. All right. So wage growth is all important. So the biggest risk that I see to the economy right now, and I would say to the dollar, and any of you guys who trade emerging market currencies, the biggest risk that I see right now is that an overheating of the US economy. Okay, because right now what we're seeing is labor market rolling over, which means it's getting softer. So companies aren't firing, but they're not hiring. If somebody leaves, they don't replace that person. Or they trim at the edges. Joe or Allison, they're not really pulling their weight. We're gonna trim them, but we're not gonna fire, the whole marketing department. Because historically that's what happens. In economics, I'm an economist, when the unemployment starts rising, the unemployment rate, it usually surges. You very rarely have this current situation where you have tick up, tick up, tick up. It's actually a Goldilocks environment. Why? Because I'm just gonna lay out the sequence. If you have a strong economy, companies hire. Companies hire, wages go up. Wages go up, services prices go up because we're a country of consumption of primarily services. Service prices go up, inflation goes up. That's the sequence. So my biggest concern is we don't see a slowdown in the economy that helps bring inflation down, or not even down, just a little bit slower, but rather forces wages higher, okay? Below 4%, I think we're okay. If wages beat 4% and go higher, then I think inflation has a very real risk of surging, of rising again. And if inflation rises, the Fed stops cutting, and God forbid, considers hiking.
Question.
Yes, please.
I'm not a fundamental trader, so for the fundamental guys, jump in if you have any suggestions. I would think as a fundamental trader, if I was looking at your information, if we were talking stocks, I think I would know what to do. But I think most of the people in the room trade currencies, and I'm sure the question is, and perhaps you will get to that, and if you will, I'll be quiet.
No.
How do they apply what you're giving us so far with the direction of, say, the euro dollar?
Yeah. The dollar goes, so I think the euro, actually I do have this in the presentation, but just to cut to the chase, euro's overvalued. I updated my fair value model, because I used to work at Bear Stearns and I was in emerging markets and I did a lot of fair value models, so I updated them for this event. And the euro, I have at fair value far lower than the 117 it's presently at. Euro has very low growth. US has robust growth. I don't think the Fed even cuts more than 50 bips. So the interest rate differential, I think, doesn't keep Europe too attractive at this point. And Europe doesn't have the productivity numbers that the US has. So if I were to make a bet, it would be on euro weakness and by the end of the year, dollar strength. Because I think there's a very real risk that the Fed doesn't cut as much as people are thinking. In fact, there's economists, I would include myself, that think the neutral rate where the Fed funds should be, that's neither inflationary or deflationary, is no longer 2%, it's even 4%, 3.5% to 4%. Fed's at 3.75. So if you think, like half the FOMC thinks, that the neutral rate is 3.5 to 4, the Fed shouldn't be cutting anymore. It's a very real debate in the economics world, in fundamentals, as to where the neutral rate is, because if we're right and the neutral rate's higher than it has been historically, and the Fed keeps cutting, then you get a weakness in the dollar, you get higher inflation, and you get a Fed that has to reverse course, and that's a bad look. Emerging markets, I think, I don't know how many are EM FX investors. I think EM is going to be the highlight of the year. I really do.
So going back to that for a second,
Yes.
two comments. I keep hearing 3% is the number, not 3.5 to 4 as far as Fed funds rate. So if that's the case, we're looking maybe one more rate instead of 2 cuts, possibly 3. And then going back to that as well as the euro, what about, do you see the euro ever getting back to parity? We've been hearing for the last 20 years, parity. We touched it this past year, I think 96 or something, and now we're back up to 117.
Yeah.
Do you see us getting to that parity play anytime soon? And you mentioned at the end of the year, if we're only doing 2 cuts and the dollar's strong and euro, et cetera, et cetera. So
I don't think we get to parity under my base case, because my base case is essentially, things keep moving along as they are. U.S. does really well. The risk trade is on. Guys look for carry. There's a lot of you guys out here looking for carry, and I think that trade continues. I think your first question was about the Fed funds. So let's just be clear. The Fed funds right now is at 3.75. I think they go to 3.25. What I was referring to with the neutral rate is what the FOMC voting members debate. So you have Steve Myron, who thinks the neutral rate's at 2%, and historically it has been. If you think the neutral rate is at 2%, the Fed can cut another 175 basis points, even 200. If you think the neutral rate is at 3, and we're at 3.75, the Fed can maybe do 3 more times at 25. If you think the rate is at 4, which I know a lot of guys that think it's at 4, okay, then
Trump and the new Fed chair, obviously we'll probably get the new Fed chair coming in. There's some political pressure for him. I know there's supposed to be separate political pressure to keep lowering, as far as the housing market, et cetera. But I guess we'll wait and see.
Yeah, and remember, it's a committee that rotates over time. So you have 12 members of the committee. How many? 7 of them are board of governors, and then you have the rest that rotate. So it's not. The Fed chair doesn't dictate policy. It's a vote. So I think it's really important to keep that in mind. So historically, the Fed has been an entity that looks for consensus. It's very rare to have even 2 dissents. So what we're looking at for the foreseeable future is something a la Bank of England, ECB, where it's close. We're talking, like 50-50, maybe one other guy or gal breaks the tie, but that's unusual for the Fed historically. But that's where we're at. So some guys say that brings less volatility. I think it brings more volatility because everyone's going to be even more locked into every Fed meeting. This chart I'd like to point out to you all. This is all, again, fundamentals. I think it's relevant because this is core PC. We're at 2.9%. What I did here was take all the variables that come into inflation and just put them into 3 buckets, trying to make it as easy as possible. Now, we have 1.9 percentage points of the 2.9%. That comes from core services ex housing. Everything else comes from housing. It's that easy, okay? So it's an economy based on consumption, specifically the consumption of services. If you're feeling good about the economy, if you have a job, if real wages are positive, you're making more money and you're beating inflation, you're still buying services. You're going to restaurants, you're traveling, you're staying at a hotel. So if the labor market picks up and the unemployment rate doesn't keep going higher but goes lower, we're in for a treat here. Because this big boy stays big. And if housing doesn't become more affordable, which it's totally unaffordable, this guy doesn't move either. Because goods that we consume, they're already negative. So I think that's important to consider. So why do I think inflation stays structurally higher? Because we're presently in a place of, I think this graph speaks for itself. Essentially, in the 1990s, when we had the tech bubble, we also had the implementation of NAFTA, GATT, WTO, all that stuff happened back then. And what we saw quantifiably is a deceleration in durable goods price index. So year on year, this guy was moving lower. So now what we're seeing since COVID is a reversal of that trend. And in fact, when you have economies that deal more of in a comparative advantage framework rather than this globalized framework, then you get more elevated prices. We haven't seen it in our core PCE numbers yet, but historically that's what happens. Okay, so that's where that is. Trade policy and yes, please.
Hi.
Yes.
You mentioned the labor market. How much does the Fed pay attention to the unemployment rate as opposed to UA?
So there's different measures of measuring unemployment. There's the unemployment rate, which is guys that are unemployed that are looking for jobs over the total population that's able to work. And then there's guys who are looking for, who are disillusioned, which means they're unemployed, but they've given up. They're not looking anymore. And that's the bigger number. That's like 10% or something like that, maybe 9%. I think that the Fed cares a lot about that. I think the Fed cares maybe as a leading indicator even more with some metric called the JOLTS, which is job openings. And if you're not familiar with this is essentially saying how many jobs are there available to each unemployed worker. In the heyday, it was 2 to 1. So every guy that didn't have a job, there were 2 jobs out there for you. 2 jobs out there for you. Now that number has dropped down to 1. So the labor market is eating up the excess, meaning there's fewer jobs available for every unemployed person. It's harder to get a job now. Jobs aren't ample. The Fed cares about that. So when JOLTS go down, unemployment goes up. I'll give you one other data point, since you asked. There's something called the neutral rate of unemployment. And all that means is that at the certain level, the economy is neither inflationary nor deflationary. And that number, in my estimation, is 5%. When unemployment is less than 5%, inflation pressures are to the downside. Sorry, excuse me. When it's under 5%, it's inflation pressures are to the upside. When unemployment is above 5%, inflation pressures are to the downside, okay? So 5% is like it's like, they call it the NAIRU, the non-accelerating inflation rate of unemployment. And so it's kind of a rule of thumb. So if you're looking for rules of thumb, that's one, okay? So I like to give people kind of like different thresholds and clear, guardrails of things to watch out for. So any other questions? Okay.
Something
Yes.
to touch upon that you mentioned earlier regarding the emerging markets. You said emerging markets are probably the place to look. Are you referring to any specific ones?
Yes, I like Brazil a lot. The carry's beautiful. The central bank is cutting rates. They've already put the kibosh on inflation, whereas DM did not. And they're probably going to have a change in leadership over the course of the next 12 months. So I think BRL is in my opinion, probably the top pick in emerging markets. Mm-hmm. I also like MXM, but it's looking fairly valued. So historically, it's unusual for the U.S. to have a deficit this large outside of war or pandemics or the crash of the financial system, which is where I was. I was here at Bear Stearns when this went under. And then COVID happened here. But we're now several years growing above potential. Potential is the pace at which any economy, and every economy has their own number. Ours is 2%. The potential growth rate is the pace at which an economy can grow without being inflationary or deflationary. So the US is 2. If we're growing at 5, it's inflationary. If we're growing at 0, it's deflationary. The GDP nowcast from Atlanta Fed just today published, did anyone see this number? Does anyone have any guess what the fourth quarter number is now projected to be? Who said 5? Correct. 5.4%. So 5.4% annualized is a great number, but it's a very unusually high number for a developed country. You don't even have Peru growing at that level.
But that's a great thing, isn't it?
It's a great thing, unless you're worried about inflation and the Fed increasing rates. But it's a great problem, except how's the Fed going to continue to cut? And how's the market going to continue to rally? I mean, I guess it could, but it's going to be tough with inflation. So these are the tariffs. We don't talk about them anymore, but they're still in effect until and unless the Supreme Court dictates otherwise. And even in that case, it's not necessarily the case. And in fact, I would argue that the US is never going to have to pay them back. Okay? They're very likely to be deemed unconstitutional, but they're not going to be paid back for many reasons. There's ways to get around it. But the point here, and you can see this as monthly numbers, they have added $300 billion to the coffers of the US government, which was actually fantastic when you have interest payments as a percentage of GDP that have gone from 2.4% of GDP to 3.8 in 2 years. So if you have new money in, you're not spending less, you're getting more money in, then you don't have to pay as much in interest payments, which is important because the US government, this is the orange line, starting in 2015, let's call it, has exceeded private sector debt and now has dwarfed it to a level that we have never seen historically. So this is something in economics we call crowding out of the private sector, and you can see it mostly manifested in the housing market, where housing market is very expensive. It's at the historic highs. That's the gray line here. That's the National Home Price Index. Year on year is still positive, but at least it's not growing at 20% anymore. But this is crowding out of the private sector. Essentially, the public and the private sector vie for the same pool of capital. If the government has to finance 6% deficit at a 4.5% 10-year treasury, they have to find people to buy that. So what happens? It drives up the cost of capital. So if you want to take out a loan, it's going to cost you more now. If you want to buy a house, it's going to cost you more now because rates are higher. Okay? So that's what's happening now. The 10-year yield is at 4.20. For some reason, don't ask me why, I just took this histogram out over the course of, let's call it 5 decades. The 10-year treasury loves 4.20. It loves it. It loves it. This is the mode. This is not the average. 4.20. It's exactly where it is.
Stands for
What?
smoking pot. April 20th. I don't smoke pot.
I wouldn't know that. All right. All right, so Treasury loves 420, and Miami does apparently too. So the 10-year yield, so this is the divergence that I'm talking about with the private and public sector, and the public sector crowding out the private sector. So historically, the 10-year yield and the US dollar have a very tight relationship. Okay, so when the 10-year yield goes up, the dollar goes up. When the 10-year yield goes down, the dollar goes down. Now that's broken down. Historically, it works, but now what we're seeing is this widening of the spread. 10-year yields keep going up. The dollar goes down, and that's because of these deficits. So on to Forex. Yes.
Do you have, or is there any place we can reference a correlation between that surplus from the tariffs with any specific currencies?
Ooh, okay. Let me repeat it. What's your name again? Uko. So Uko's question was, is there any analysis that you can do tying the surplus from tariffs into benefit of a currency, correct? Apart from the US dollar is, I assume, what you mean.
Even one that took a dive from it. I mean, money is money, right?
Well, the dollar benefits from it, of course.
Right.
The dollar benefits from it, of course, but we've seen the dollar weakening because you have countervailing forces. Forex, I admire you all because Forex has so much going on. Foreign exchange, the US dollar should be weakening because you have a fiscal deficit, you have a current account. So fundamentals say the dollar should be weaker. However, when you look at carry, when you look at interest rate differentials, which I would argue is the main driver of Forex, I mean, you all are more technical savvy than I am, but fundamentally, you go to Asia, tell me, I don't care about that, tell me about S&P 500. Tell me about the Mag 6, tell me about the Mag 7, tell me what the next AI trade is. My point here is that you can have an atrocious fiscal deficit, atrocious current account deficit, and if everybody wants to buy your stuff, your dollar is supported. One. Point number two, if there's no alternative, you've got a hold on that market. So I'm a capitalist. Look, I think competition makes us all better. There is no competition for the US dollar. There's no competition for the Treasury. Until there is, the US can keep running massive fiscal deficits and find buyers for them. Because really and truly, the 10-year Treasury should not be at 420 right now. It should be at 520. It should be at 6.
One more question.
Yes.
And I'll shut up. Last thing, you mentioned tariffs. This is kind of a whole new game with these tariffs. And if the Supreme Court goes against it, rules against tariffs, how do you see that affecting the stock?
I don't think it matters at all.
Really?
I'll tell you right now, everyone's expecting it. It's completely priced in, no one cares. Same thing with Greenland, no one cares. Same thing with the Fed, DOJ, no one cares. Doesn't matter.
Do you think it'll affect the dollar more?
I think it's already baked into asset prices across the board. Everyone's expecting a ruling to come out. Who asked that question? I don't even know. Okay, sorry. Everyone's expecting this. I don't think it's going to cause a roil in the markets. I think the question is, do we have to pay it back?
Right.
So if you have to pay it back, it's gonna be a major issue. But from what I understand, is that there are mechanisms of not paying it back that will be deployed. So I'm gonna call that a not major market mover.
So it's not going to be the end of the world.
Correct. And the markets are already expecting it.
Right.
I mean, think about it. How many end of the world scenarios have we had? I mean, Liberation Day lasted for a month or something, and the markets tanked 25%, and then it was off to the races. So these are in essence what I'm looking at here. I think the U.S. dollar weakness, the Fed is cutting. The dollar loses some carry appeal. Risk appetite remains strong. So guys look elsewhere to get some carry and get some juice. I think the U.S. This is my baseline. I think the U.S. growth slows. If I'm wrong, then it's a different scenario. But my base case is that we get a slowdown in U.S. growth. So we don't keep 5% annualized rates. We go back to 2%. High fiscal deficits, it's a structural headwind. And global risk appetite, usually that leads to a weaker dollar, and you look elsewhere for juicy yields. So the yen, of course, I assume a lot of people trade the yen here. I would love to hear your opinion as well, if you're willing to give it, but
Against the dollar or against the sterling?
I don't know, what do y'all do?
Well, against the sterling, I think it's a JPY weakness for at least another
Yeah,
2 years.
because you see the sterling, because on both fronts, right?
Yes, because the Bank of Japan, I mean, while they've increased interest rates, I think will put themselves in a position where they remain the carry in the global market. So more people hold in other currencies given the lower yield.
They're funding.
Correct.
Do you think they'll start funding in euro?
Well, they buy a lot of U.S. Treasuries, so
Yeah, Japan does.
Japan.
Yeah, Japan, yeah.
Now, against the dollar, I'm not sure, but against all the other currencies, I think the weakness of the Japan's.
That was another thing that called my attention, that once the JGB started being positive yielding, I thought, oh, that's terrible for the US. Because that's a complementary asset. So when the JGB was negative, all the Japanese, buying our stuff, but now when it's positive, they can buy their own stuff, which they historically do. They own 70% of their own debt. So, but I would like to hear your thought. If you think that the constraining factors are BOJ hiking, inflation. Fundamentally, one could say that that the JPY should strengthen. This is an economy that's now growing. BOJ is probably going to hike. But yes.
So many people in this room are waiting for, or wondering if Japan is going to intervene in the yen. It's been speculated for a couple months now. Do you have an opinion as to whether or not that may happen?
It's good for their stock market, the weak yen. It's kind of good for their currency. I don't have an opinion as to whether or not they will intervene, in the sense of, I'm assuming you're talking about buying currency.
Yes.
Okay, because they could hike rates, which I think they will do. But what do you think? Do you think they could do that? They historically do not, right?
Up around these levels in dollar yen, they have previously.
Oh, okay.
And right now, it appears that they may be letting it go for a little while. People have been waiting for months to see
For them to
happen,
intervene.
and they haven't yet. So I don't know.
Yeah, I don't know.
Would it have anything to do with the tension over there?
And the market's doing their work, right? Their job.
Yeah.
And it's been working, so what incentive do they have to intervene? If
To bring
the
it down
market's
to-
doing the work for them, why?
To bring it down to 148.
I don't
Yeah,
see it
clear.
happening. They've
I'm
had
just
multiple
asking.
opportunities.
Here's the greater question, though. Regardless of whether they intervene, the carry still favors the dollar against the Japanese yen. So even if they hike, I think more people will still hold on the US dollar, and that'll continue to depreciate the Japanese yen.
Yeah, very well could. So you're short yen, long sterling, I know.
Long sterling.
We haven't reached the levels yet where they intervened the last time.
We have or have not?
Have not.
Okay.
So it's possible that.
They're still waiting to
they're
get to-
waiting to get to that. But we are not too far.
But Manny makes a good point. Why do it yet?
Well, it's just by saying that they're going to, it's, I think, putting some brakes on on more buyers coming in for dollar yen.
Mm-hmm.
So, yeah, it's just a mind game.
Yeah. So this is your currency. So fundamentally, the pound has a lot of headwinds. So maybe technically it looks good, but they're cutting. Their growth is slow. It's losing its role as a high carry G10 currency. And it could become a funding currency rather than a leader. So that's kind of what we're looking at, instead of being a carry winner, kind of underperforming. And this is generally consensus, at least from when I talk to my peers as well. Same thing with the euro, fundamental wise.
For the technical guys.
Please, yeah.
If you examine a chart,
Yes.
you see the hard level of resistance when the BOJ increased rates last year, right? And then it sat there in the range of 190 something, and during Christmas time when it was rumored they were going to hike again, it broke out of range. And I think we're looking at 230 before it reverses. So I'll be surprised if anything can happen to that.
Is anyone here bearish on the pound?
Against the Japanese.
Or against the dollar? No? So the trend continues as general consensus, I guess.
This is another big one, the Swiss franc. I mean, when we look at sentiment, something like 95% of clients are long dollar Swiss, which to me, you know, I'm more of a contrarian. That lights up my eyes because I think that puts dollar Swiss lower personally myself. 95% of retail clients are long in one currency. I see that as a major red flag.
It has been in a like 120,
Range.
150 point range for
Yeah.
6 months.
What do you think is happening on the Swiss franc here?
Yeah, I mean, it's certainly been, you know, strong, and I agree with you. I tend to think that, and when you have retail guys, especially retail, but also Wall Street, all in favor of one thing, I tend to be a little bit of a contrarian myself. But I mean, what do technicals say? You all are technical experts. This is the fundamental view. Still further?
I mean, it's tougher because from a technical perspective, if we get much lower, we don't have much, data below these levels. And when you get into fresh territory like that, you throw the technicals out the door. You don't have anything to base it on, and so there might be a huge liquidity grab, 2 or 3 cents, 200 or 300 pips lower from here. That's just my personal opinion. So, but I do see that grab happening, and I do see dollar Swiss putting in new lows sooner than later.
It's interesting.
Force this even more than dollar yen.
Do you want to give him a mic, or does he have?
Bassett.
What did you say?
Bassett, you want the mic?
No, I can shout. What I was saying is that the carry actually favors dollar Swiss even more than dollar yen.
That's right, because they're still at zero, right? Their rates are still at zero.
Right.
Yen is at 0.1 now, so you're right about that.
I mean, fundamentally, this is one of the strongest names globally, so it makes sense to be long it for sure. Moving to the euro, I'm bearish. I think that, I mean, even when you look at my fair value, this is not a prediction. It's the fair value. I look at different variables. It's a multivariate regression model, and there's nothing technical about this. So essentially what I'm saying is early in the year you get US dollar weakness, we're expecting Fed cuts, and then you get a narrowing of the interest rate differential between the US and Europe. So technically, we could see it strengthen further, and it has been. It's at 117 today, but fair value I have at 108. So look, if the ECB keeps easing, and the Fed, let's call it the Fed doesn't, or the Fed hikes, then that's bad news for the euro. Growth and yield divergence versus the US, there's no comparison. And then productivity is massively underperforming, and growth as well. So when you look at nominal growth between Europe and the US, Europe is really pulling up the slack. I'll let you guys look at this later. These are other G10. Oh, and then we skipped the emerging market currencies, but I'm happy to take questions now, or comments. If you have any other views, I would love to hear them as well, especially from a technical perspective, because that's not my area of expertise.
Don't be shy, guys. This is an opportunity right here.
Well, I would like to hear your opinion about the Fed. Did they take too long to raise the rate, and now taking too long to reduce it? What's your evaluation of?
All right, I'm going
to
give you my hot take on the Fed. A lot of this is of the Fed's own making. because we had fiscal and monetary stimulus far longer than we needed to have. Remember that the Fed was trying to juice the labor markets for about a year and a half longer than it needed to. And in fact, that's one of the reasons why I like Brazil, because they started hiking rates a year before the Fed. They hiked 1,000 basis points. They curbed inflation. They completely got rid of it. And now they're able to cut rates. On the flip side, what has the Fed done? The Fed has taken the balance sheet from $1.7 trillion to $7 trillion, has kept it there, slowly rolls off, doesn't sell, and it continues to juice the markets. I think a lot of this is of the Fed's own making. And I would lay the culpability on both fiscal and monetary stimulus, which exceeded where it needed to be. So with regard to what happens now at the Fed, I think that Kevin Hassett seems like he's out. And I'm gonna throw a name out there, and maybe if I'm right, y'all remember me. But I think that the BlackRock guy could be the next Fed chair, Rick Rieder. And if he's the next Fed chair, he's not a bad option. But if he is, he's kind of like the Black Knight, you know, the guy that no one really, I think people are talking about him, but he would be the guy, because everyone was thinking Chris Waller, Kevin Warsh, Kevin Hassett. It might be Rick Rieder. So if it is Rick Rieder, and I suspect that the president is going to name him soon, because remember that Powell's term ends in May, and if there's not a replacement who has to be approved by Congress, then President Trump's favorite buddy in the world, Jay Powell, stays on, right? So Trump wants to get this going. So it might be Rick Rieder. If it is Rick Rieder, expect both treasuries and equities to rally, and expect the dollar to weaken. Expect EM to fly, and expect your trade to do very well. The majors against the dollar. Because I think the markets are going to price in a full throttle on the economy, lower rates, fiscal deficit might improve because of the tariffs slightly. So we'll probably get 5% fiscal deficit. But my impression of this economy is that it's full throttle, all engines go. And if I'm right, inflation remains an issue. So it could be Rick, it could be Chris Waller, it could be Kevin Warsh. A guy that works with me is the former Fed whisperer. He's the Wall Street Journal. He was there for 30 years, John Hilsenrath. And he told me that he thinks that Hassett may have declined the job. Yeah, because of the pressure to cut rates.
I don't think it's going to be
Makes sense.
Well, not after President Trump said, yeah. I think that was a subtle nod that it's not going to be him.
The next Fed, what if he raises rates? I mean, the guy is supposed to
He's gonna get fired.
I mean, I hear that, but I mean, if they're, look at the numbers, they have their own formulas.
Yeah.
You could come in and.
Well, that's probably why Hassett didn't take the job.
Straight up say, no,
Yeah.
we have to raise rates no matter what.
Yeah.
You change your formula.
Yeah. No, I think you make a good point.
Kind of mix it.
Yeah, you make a good point but remember
Work
that.
independently, but,
Yes. Yes, there is supposed to be some accountability of the Fed, so it's not it's not the Pope ex cathedra. So the Fed can make mistakes. Let's be clear on that, and I think they have.
I agree.
Yeah.
Powell's waited too long to do things. The European Euro, they cut rates before us, and they usually do it after us, never before us.
Mm-hmm.
And that was probably a sign right there.
You know what would be really interesting? The worst thing that a central bank can do is cut and then hike within a year, or hike and then cut within a year. It's like the worst thing that can happen. So then what happens to the dollar there? I would argue that the dollar strengthens because everybody's scared to death. I mean, what happened when Moody's cut the S&P AAA rating? Everyone flocked to the Treasury and to the dollar. So it still remains the safe haven of the world. And it's kind of this moral hazard risk if you think about it, because there is no other asset. I think we cut this graph out, but China has started selling treasuries, but there's only so far China can go. It's not like they can sell all their treasuries, because what else are they going to buy? You can buy all the euro-denominated bonds in the world. You can buy all the gold. What are you going to buy? So.
Gold.
Energy.
They're already buying gold. They're already buying copper. but they have multi-trillion dollars in fiscal surplus and current account surplus. So you can buy all the gold you want, you're still going to have leftover money. And then you have the dollar as the sovereign reserve currency of the world. What's going to replace it? Bitcoin?
So what's your
Never.
thoughts on that? There's certain countries that are trying to dissolve, getting away from the dollar. There's certain countries trying to get away from the dollar.
Yes, but what I'm saying is that right now there's no alternative.
No, obviously.
Right.
Yeah.
So like Brazil can do all this fun stuff about the BRICS currency and all that stuff, but they still own all their zero. Absolute, no, zero for sure. And they still own all the reserves in dollars.
Yeah. I just hear, talks.
Oh, sure, there's always, but notice there's always this death of the dollar narrative every single year. And I'll believe it when there's an alternative. And I think the yuan could eventually get there, but I'm talking not in my lifetime, because they'd have to start now. They'd have to open their capital accounts, they'd have to free float their currency, and they're not doing that.
Right.
And Europe's a mess. So I think we can continue this ride. I think you want to be overweight in high carry currencies. I think the dollar stays weak. I think the S&P makes all-time record highs this year.
And the euro has gone down.
I think the euro goes down. I think by year end. I mean, maybe in the near-term momentum.
It has so many problems.
Fundamentally, yes. I think the euro goes lower.
I'm going to show the euro eventually.
What are you looking at, 120? You want to short at 120?
105.
Yeah, I'll go all the way at 120.
There it is.
That's not a bad idea.
I'm working on it.
Well, if no other questions, thank you so much for your attention. It's been a pleasure. Oh, please, I'm sorry.
Yeah, I was trying to see about the Canadian Swiss franc.
Do you want to take the mic just so everyone can hear you?
Okay. No, I was trying to see what was your opinion on the Canadian Swiss franc.
Ooh.
Right now, when you load all the historical data, it started like at 126. Now it's down to like 50, 56 or something like that. And right now, Canada, the crude they used to sell to U.S., but now Trump has got a hold of Venezuela.
Mm-hmm.
Got all the crude from Venezuela, so they're not, might not need Canadian crude anymore.
Right.
But the Chinese were getting crude from Venezuela. And so
Right.
now,
That's a
since
very
Trump
good
has
point.
it now, I'm thinking, and I heard on NPR that Canada and China has some type of trade deal.
They do, yeah.
So,
Or they're talking about it, yeah.
yeah, I'm trying to see whether or not that's gonna cause the Canadians to push bullish if China starts to get the crude from them, since Trump has all the crude from Venezuela.
That's a really good point.
Because right now, like I said, I'm looking at this, I just pulled up the this is the total historical values, the downtrend.
Interesting.
I'm talking about from the beginning, this is the yearly, that's the yearly, it started at like say 120, now it's down to 50 something. So I'm thinking it should.
If that plays out, that will work great for them. But China can also get their stuff from Russia, right?
Yeah.
I mean, that makes, I agree with you, and that would be great for Canada if they got that deal, but I'm just not a believer that, did you hear Howard Lutnick? He was like, that's never gonna happen. Like China will export to Canada, but they're not buying their stuff. So if that were to happen, that would be great for, I would say, Canada, but I think China has other options. But that's a good point about the Venezuelan crude. But you know what I would say before China gets lit by that? Cuba goes under before China does. Because Cuba was living off of Venezuelan oil. But I like your idea, I do. If it pans out,
Because the enemy of my enemy is my friend. Right now, U.S.
That's true.
have bad relations with Canada, and Trump seems he's very retaliatory. So I'm thinking he's taking
Yes.
the crude from Venezuela, so he doesn't have to get crude from Canada
Correct.
anymore. And so that's going
But we have our own crude too, right?
Yeah.
U.S. We're energy independent. But I like your point, and like following your logic, that's why I got bullish on emerging markets in the first place, specifically Brazil and Mexico. Not to go, it's related, I promise you. But my thinking was the trade war benefits whom? If the U.S. and China, which are number one trade, well, you have Mexico and Canada, but if the U.S. starts to do the nearshoring more and more, Mexico and Brazil are the biggest. I would say Brazil's the number one beneficiary of the trade war, and it has been. Actually, if you saw did you all see the BRL today? Off to the races. Like the BRL is I would call overvalued at this point. But Brazil is benefiting from the deterioration of the relationship between U.S. and China, because the U.S. is like, come Brazil, be my best friend. So you make a good point though about the enemy of your enemy is your friend. I like that idea. I just don't buy it. I don't know if China's going to be a really faithful partner to. Maybe. Yeah, they're talking.
I heard on NPR as far as the trade, so.
It's just talk.
Yeah, I know that Canada's looking at hoping for that. Yeah.
Just talk.
Yeah. At this point, I don't think they've signed anything.
Being from Canada, they're not.
Oh, you're Canadian?
Yeah, I was talking with him earlier. That's why I just wanted.
I like the idea though. I like the idea though. Any other questions? All right, thank you so much. Thank you.
Everybody, thank you so much,
you.
Kathryn. Thank you.